Hello, wonderful people. I hope you are fine. And I wish you a happy holiday. Barakat Salah to the Muslims. Yes. So we are live on Joy Learning channel, the revision edition on the SHSR. So I'll be taking you through economics, and my name is Sir Walter. Today we'll focus our attention on the topic public finance. As we do in economics, I want you all to hold all other factors constant, with the exception of the public finance that we are going to do. All right? I want you to give me your maximum attention as we go through this successfully. And I can assure you that by the end of this lesson, you will go with a very great knowledge in this particular topic. Yes, so for the Form 3s, you may have done it in school, so it will be a revision. For the Form 2s and Form 1s, you can take the opportunity to learn a Form 3 topic, so that by the time you get there, you will not be found wanting. So by the end of this lesson, I expect you, the students, to be able to define tax. Then also outline, before that, you define the types of budget. You should be able to define the types of budget, Then outline the sources of government revenue. Then also state items of government revenue. Then lastly, explain the incidence of tax with diagrams. So under this topic, we'll talk about budget and taxation. But our major focus will be on taxation. So what is public finance? Public finance concerns itself with government revenue and government expenditure. So we are talking about how government gets money and how the same government spends the money. Right? So in other words, we'll say, how does money get into the public purse? And the money that gets into the public purse, how do we spend it? Good. So when we look at the structure of this particular topic, public finance, we'll be looking at budget on one side, and we'll be looking at taxation on the other side. When we look at budget, it will cover the sources of government revenue, and it will also cover items of government expenditure. Then when we come to the taxation, we'll go into details to talk about incidence of tax. So then we start with what a budget is. A budget is a financial statement that shows a country's proposed expenditure and estimated revenue. Now I want you to take note. With this particular definition, we have proposed expenditure, then we also have estimated revenue. Budget is a financial statement, and it is quite different from the normal financial statement we know. Those of you who do business as your program, you've learned that in financial statements of many of the firms, we talk about what the firm has spent on in a particular year and the revenue they got in that particular year. All right? But when it comes to budget, we are not looking at what we have spent and what we got as revenue, but rather we are looking at what we will get as revenue and what we will spend on. So budget is a bit unique from the normal financial statement. With a normal financial statement, it talks about what has happened, but budget is looking at the near future. I hope you've taken note of that. So in trying to define budget, always make sure you talk about the fact that it shows the proposed expenditure and the estimated revenue. It's very, very important. Now, we should know that budget can be balanced or unbalanced. So when we talk of the balanced budget, it is a budget which has the proposed expenditure equal to the estimated revenue. And when the proposed expenditure is not equal to the estimated revenue, it becomes an unbalanced budget. Now let us look at the types of unbalanced budget. We have the budget deficit and the budget surplus. The budget deficit is that kind of budget where proposed expenditure is greater than the estimated revenue. So if you have a particular budget which has the proposed expenditure greater than the estimated revenue, that is a deficit budget. And many countries, especially developing countries, run deficit budget. Yes. Especially in the election year. Government spends a lot. Government spends more than it receives. Now we talk of the surplus budget. On the other hand, it is the situation where the estimated revenue this time around is greater than the proposed expenditure. So we get an amount of money as a nation and we spend less of that money. Then we are running a surplus budget. Very few countries run surplus budget. Take note. Then let us talk about government expenditure. We made mention of the fact that the budget talks about government expenditure and it talks about government revenue. So we'll pick the government expenditure component of it and talk about it. They are the total expenses made by government institutions at all levels. When we say all levels, we are looking at the central government, the arms of government. We can come down to the district assemblies, even before that, the regional level. We come to the district level, then we go to the electoral areas, with all levels of government machinery. The expenses that goes on there is put together, and the total is the government expenditure at a given time. Normally it is measured within a year. Some items government spend money on are administration. Yes, government has to pay cabinet ministers, government has to pay the legislature, judiciary, government workers. Yes, all those who help in administering the kind of governance we have, they need to be paid. Security, very, very, very important. We have lots of forces under the security service. The Ghana Armed Forces, we have the Navy, we have the Fire Service, police. All these are helping to keep our security. All right? The government spends money on them. Agriculture. Food is very essential to our lives. So government spends a lot of money on it. Education. We can even mention health. And so on. Now let's move on to forms of government expenditure. Government expenditure can be put in two forms. We have the recurrent expenditure and the capital expenditure. Now let us look at what recurrent expenditure is. These are expenses incurred on items that reoccur periodically or on periodic basis. Example, salary. We know every month government would have to pay salary. It reoccurs periodically. Then we go to capital expenditure. It's a one-time expenditure on items that last for many years. Example, roads, dams, schools. Akosombo Dam was built some years back. And that was it. It's a one-time expenditure. Now you might think, every now and then in the budget that is being read by government, you see roads. They reoccur. So you might think that road is a recurrent expenditure, but no. The roads that occur in the budget every time the minister reads the budget was built or was constructed some years back, and it is not reoccurring in the budget. Again, at least for some time, it will not reoccur in the budget. Right? That is a capital expenditure. So take note. We are talking about a particular road construction. That is a capital expenses. I hope that is clear. Now let us move on to revenue, the revenue side. It is the total amount of money raised by government in a given year. Government raise money to do the roads, to maintain our security, to provide other essential services for us. And some of the sources of government revenue is tax, money from international financial organizations like the IMF, like the World Bank. We can even get money from international donors. All right? Sale of securities. Yeah. Government institutions, when they float shares, or when government raise bonds. All these, when we sell them, we get money for the country. Sale of assets. Yeah. State assets, actually. So we move on to the forms of government revenue. And this time, we also talk about the recurrent and the capital revenue. Now to the recurrent revenue, like we said in the capital expenses, we said in the expenditure. It is revenue we get from regular sources. It comes periodically. So taxes, fees, and fines. Every month we get money from there. It can even be on daily basis. Good. But when it comes to the capital revenue, it is money we get from irregular sources. Example is the sale of assets. We don't sell assets. We don't sell state assets every now and then. It's a one-time something. We sell a particular asset. It's not as if every day we are selling assets. It's not as if every month we are selling assets. It comes once in a while. So that one becomes an irregular source. So take note. Now we move on to taxation itself. Tax is a very important source of revenue for government. Just imagine government without tax. That means government is going to lose a lot of money. We've heard every now and then that taxes have helped lots of countries. When you go to the developed countries, their tax is a compulsory payment. It is compulsory. Compulsory payment levied by government on incomes, properties, goods, and services. Now, you should note that when we want to term anything, any form of payment as tax, it should be compulsory and it should come from government. It is not levied by anybody, with the exception of the government. Yeah. So government levies us to pay something in a form of tax. One may ask, why should government levy us? Or why should government take money from us? Now we should know that there are a lot of things government is doing for us that requires money. Who constructs roads in the country? To a very large extent, it is the government. Government has the onus of creating jobs. Government provides us with security. Sometimes government gives subsidies to producers. Government does a lot of things that requires money. With the international agencies that we join, like ECOWAS, like AU, our contributions we make are made for us by the government. And government needs money to do all of these. And for that matter, there is a need for government to take some money from us, gather it, and use it for its purpose. So that at the end of the day, we can all maximize welfare. All right. Now you should know that tax is either direct or indirect. Tax is either direct or indirect. Now let us look at what direct tax is. When we say direct tax, they are taxes levied by government on incomes and properties. Taxes levied by government on incomes and properties. Why would government levy us on our incomes that we receive? Why would government levy us on the properties that we have? We should note that government creates that enabling environment for us to get money. Even if you are not employed by government, you are employed by the private individual. In that private firm, there are one or two things government has done. Government has laid electricity lines from the source, if it is Akosombo Dam or anywhere we are drawing the power, to the town, so that your firm will tap from it. it will be a very huge burden on that firm to go and tap from Akosombo all the way to wherever they find themselves. Government has created that enabling environment. The roads that will lead to the place, government has done that. So with this enabling environment government has given us, we also have to give government something to continue with it. That is why when we get that income, government takes a portion of it as tax. We build our properties or we acquire our properties and government says we have to pay taxes on it. It's only fair, not so good. So some of the examples of direct taxes are income tax, estate tax, corporate tax, capital gains tax. Income tax, that is taxes directly on our income. For example, at the end of the month, the salary or the income that is due you becomes your gross income. Government will take the tax from it, and what is left with you becomes your disposable income. So when we take all the deductibles from your income, what is left with you is disposable income. So take note, disposable income is your income minus tax. Right? Then we have the estate tax. Estate tax is the same as the property tax. So when you have acquired property, you should know that one way or the other, government has helped you to acquire this property. So you have to give government something in the form of tax. Corporate tax. If you formed a business, a firm, the government created that enabling environment. And for that matter, when you get your profit as a firm, you give government a portion of it as tax. Capital gains tax. This is very interesting. Government is saying, aside our income, if we should gain extra income, we have to pay tax on it. So if you are working and you get a side job that is going to give you an extra income, you have to give government something. Because government is going to use that money to seek for our welfare. I hope that is clear. Yeah. So we move on to the indirect tax. Indirect tax, they are taxes by government on goods and services. So when the taxes are on goods and services, they are indirect tax. It is not directly levied to anybody. You only have to pay that tax when you go to buy the good or when you go to enjoy the service. So some examples: excise tax. When we say excise tax, they are taxes levied on locally manufactured goods. We have import tax. We have export tax. So all these are taxes levied on goods and services, and they are indirect in nature. That's why we call them indirect tax. Good. We have systems of tax, and let us look at them. When we say systems of tax, we are looking at three different systems: proportional tax system, progressive tax system, and regressive tax system. Now let us look at the proportional tax system. When we say proportional tax system, it is the tax system that allows people to pay the same tax rate irrespective of their income. Please take note, we are not talking about tax amount, but rather we are talking about tax rate. Very important. The proportional tax system allows people to pay the same tax rate, not tax amount. The reason is the tax amount is not the same as the tax rate. Tax rate is the amount you are paying as tax in percentage. So it won't necessarily be the same when we look at it in the tax amount, but when we find the percentage of it, it should be the same. And if that is the case, then the tax system is a proportional tax system. So the table on your screen gives us a clear understanding of what the proportional tax system is. We have individuals in the country, A, B, and C. Individual A takes 5,000 as income. Individual B takes 4,000 as income. And individual C takes 3,000 as income. If you look at the tax rate, they are all paying 10%. The same tax rate. But you would bear with me that the tax amount may not be the same. So the focus is on the fact that with proportional tax system, individuals pay the same tax rate. Good. Then we go to progressive tax system. In a progressive tax system, it is a tax system that allows people with higher incomes to pay higher tax rate, and people with lower income pay lower tax rate. So as your income is increasing, your tax rate is increasing. And as your income is low, your tax rate is low. The table gives us a clearer understanding. So we are using the same individuals where A is receiving 5,000, B receives 4,000, C receives 3,000. Now A pays a tax rate of 30%, which is the highest because it has the highest income. Followed by B, 4,000, it goes with 20% tax rate. And C, which has the lowest income, will pay the lowest tax rate. That is how the progressive tax system works. Right? Then we go to the regressive tax system. Regressive tax system. It is a tax system that allows people with lower income to pay higher taxes, and people with higher incomes pay lower taxes. You might think this is not fair. Well, it could be. But the practice of this regressive tax system wouldn't be as direct as this, where government will say, hey, those with lower tax incomes, those with lower incomes, you are paying higher taxes, and those with higher incomes, you are paying lower taxes. No. Mostly, what makes a tax system a regressive tax system is when everybody is paying the same tax rate. When everybody is paying the same tax amount, this time tax amount. So, if people are paying the same tax amount, irrespective of their income, it is regressive in nature. Let us demonstrate this and see. All right. So we have individuals, A and B. All right. And let's say A receives an income of 100 and B receives an income of 50. Now, let's say government has asked all of them to pay a tax amount of 10. So the amount A is paying as tax is 10, the amount B is paying as tax is 10. Let us find the tax rate and see. What is 10? What's the percentage of 10 to 100? So it will be 10 over 100 times 100%. So this will cancel this and we get what? 10%. So the tax rate is 10% for A. Now let us look at the tax rate for B. It is 50 over, it is 10 it is 10, the amount, over 50 times 100. Then this goes here 1. Then 5 goes here 1. 5 goes here 2. 5 times this is 20. So you would notice that as the income is 50, the tax rate is 20. And as the income is 100, which is a higher income, we have a lower tax rate, 10. So if government asks people to pay the same amount irrespective of their incomes, it is regressive in nature. A typical example is the indirect taxes we pay. When a tax is levied on a particular good, let us take a bottle of water. If government imposes a tax on it, the same tax amount, the rich buys water, the poor will also buy water. So when the rich and the poor buy water, they are paying the same tax amount, and that is regressive in nature. I hope that is clear. Yes. So, that is how the regressive tax system works. Now, let us try to have a graphical representation of the progressive, regressive, and the proportional tax systems. For the proportional tax system, you'll notice that the same tax rate is paid irrespective of the incomes. So if we are using the table, represent the horizontal axis by the income, while the vertical axis will take the tax rate. So if you look at the incomes, they are 5,000 to 3,000 or 3,000 to 5,000. So we have 3,000, 4,000, and 5,000. And the tax rate is 10%. So at 3,000, you are paying a tax rate of 10, at 4,000, a tax rate of 10, and at 5,000, a tax rate of 10. You put that together, and you get a horizontal line. So that is the proportional tax system. Now let's go to the progressive tax system. With a progressive tax system, we have the tax rate, I want to represent by T. We have the income, I represent by I. We have our 3,000, 4,000, and 5,000. Then the tax rate is 10%, 20%, and 30%. So 10% will go with the 3,000, 20 goes with the 4,000, and 5,000 goes with the 30%. You join them and you get the positive slope curve. So the progressive tax system has a positive slope curve, whilst the proportional tax system has the infinite slope curve. Now to the regressive tax system. We have our tax rate T and our income I. So the incomes are 3,000, 4,000, and 5,000. We have 10%, 20%, and 30%. So this time the 10%, which is the lowest tax rate, goes with the highest income. The 20% goes with the 4,000, and the highest tax rate goes with the lower income. When we join the lines together, we get the regressive tax curve, and that is negative in terms of the slope. That's negative in terms of the slope. Good. So with this piece of information we have about the systems of tax and the types of tax, let us solve this question. This is WASI, June 2015. So this question says, the table below shows the incomes and rate of income tax levied on 4 professionals in an economy. Use the data to answer the following question. So from the data, we have doctors receiving 8,000 with 10% tax rate, engineers 7,000, 12% tax rate, civil servant income 5,000, 18% tax rate, nurses 6,000, 15% tax rate. All right. So the question says we should calculate disposable incomes for the 4 individuals. I told you that disposable income is the income minus tax. The income minus tax. Now, when we look at the question, the tax amount is not given. So we need to find the tax amount. Then we subtract it from the income. And how do we get a tax amount? It is the tax rates percentage of the income people are receiving. So let us try it and see. Now, for doctors, they receive 8,000 with 10% tax rate. So, with doctors, they have 8,000 and the tax rate is 10%. So, if we want to find disposable income I want to represent by YD. YD, disposable income. It is equal to the income which I want to represent by Y minus the tax. So in this case, our YD will be equal to the 8,000, which is their income, minus the 10% of the 8,000. I hope you get it. So 8,000 minus, what is 10% of 8,000? It is 800. So if we have 8,000 minus 800, then the answer will be 7,200. So this will be the disposable income for doctors. Let us try that of the engineers. You can be working with me. So the engineers do 7,000 to 12%. 7,000 to 12% for the engineers. So 7,000 to 12%. So our disposable income becomes 7,000 minus into bracket 12% of the 7,000. Good. So when we find 12% of the 7,000, that gives us 840. So 7,000 minus 840. All right? That gives us 6,160. So 6,160. And that is the disposable income for the engineers. For civil servants, it is 5,018%. So 5,018%. So let us try and see if we can do it down here. Civil servant, CV, 5,018%. So YD this time around is 5,000 minus 18% of the 5,000. Now the 18% of the 5,000 gives us 900. So we have 5,000 minus 900. So that gives us 4,100. So we found that. Let us try to find out of the nurses. So the nurses too, it is 6,015%. So 6,000 for nurses is to 15%. So YD is equal to the 6,000 minus 15% of the 6,000. So 15% of the 6,000 gives us 900 minus 6,000. That gives us 6,000 minus the 900 gives us 5,100. So we've been able to find the disposable income as our first question. I want us to take a short break. And whilst we are at the short break, we continue calculating for the rest. So see you in some few minutes' time. Okay, welcome back. And I hope you have done the question. And you didn't have any problem with it. Yes, for those who had problems, yes, we will address it whilst we solve the subsequent ones. Good. Yeah. So, with what we have on our screen, I've tried to insert the figures that we found on the table. So we are getting 7,200 for the doctors, 6,160 for the engineers, 4,100 civil servants, and 5,100 for the nurses. That's our disposable income. Now the next question is calculate the disposable income. What system of tax or taxation was employed? Now if you look at this table very well, you would see that 8,000 is the highest income, paying 10% as the lowest tax rate, followed by 7,000 paying the second lowest, followed by 6,000 paying 15, and the lowest is 5,000 paying 18. So your guess is as good as mine. It is the regressive tax system. And our reason is that people with higher incomes are paying lower tax rate, and people with lower incomes are paying higher tax rate. So that settles for the C. With the D, it says, with the aid of a diagram, explain the system of tax employed. Now take note, you don't just have to draw the diagram. You don't just have to draw the diagram like this and leave it. You would need to respond to the data. This is a data response question. So what you need to do is that you put in your incomes. So from 5,000 to 800, you put in that income. So we'll draw a new one. Put in your incomes: 5,000, 6,000, 7,000, and 8,000. Then you have the tax rate, which starts from 10 to 18. So we have 10, 12, 15, 18. So you have the 10, 12, 15, and 18. Then you respond to the data accordingly. You draw. Then when you draw, you explain that those with the highest tax rate are the ones with the lowest income, and those with the lowest tax rate are those with the highest income. Then you are good to go. So you do all these questions, just these few questions, for 20 marks. And it was that easy. Now we'll shift our attention to incidence of tax. Very, very important. Incidence of tax. Now, incidence of tax talks about the tax burden borne by consumers and producers. Or we'll say it is the final resting place of the tax. Government will impose a tax. And when government imposes a tax, someone has to pay. It is either the consumer pays, or the producer pays, or the tax burden is shared. So the tax burden that will be given to consumer or producer depends on the elasticity nature of demand. We will take this opportunity to have some review on elasticity of demand that we did previously. We said that when the percentage change in price causes no change in quantity, then demand is perfectly inelastic. When there is no change in quantity as prices are changing, perfectly inelastic. When percentage change in price causes smaller percentage change in quantity, demand is fairly inelastic. It means that with this particular elasticity, when the price increase, with the first one, the perfectly inelastic demand, when price increase, consumers will not complain. They will still buy it. And this goes for goods that are very essential. They will complain, but they will still buy it. And with fairly inelastic, even if they will reduce their quantity, it will not be that much. They will still buy it. I hope you get it. Now, if water bill goes up, people will try to minimize the use of water. But to what extent? It would have a small or little impact, because water is very essential. You can't say that you want to reduce the quantity of water you drink because the price of water has gone up. So that is a clear case of inelastic demand. Now let's move on to the situation where a percentage change in price will cause the same percentage change in quantity demanded. We learned that to be unitary elastic demand. So the same change in price is causing the same percentage change in quantity. And when the percentage change in price causes a greater percentage change in quantity, then demand is fairly elastic. Normally it happens with goods with substitute. If the price of Omo is going up, we will resort to the other powder soap like So Clean, like Ariel. Good. So you realize that our quantity will change drastically. Lastly, when at a constant price, quantities are changing, then demand is perfectly elastic. So having gone through the elasticity nature, let us see how this will relate to incidence of tax. So we will assume the cost of producing a good, let's say good X, to be 10. Okay, we want to put all our profit, cost of production, everything together. It is 10 cedis. So when we come and sell it at 10 cedis in the market, we are sorted. Now, let us also assume that government will impose a tax of 3 cedis. Let us explore the market prices. Now we know that our cost price is 10 cedis. Okay, government has imposed a tax of 3 cedis. Good. So, if the market price, option 1, we sell the thing at 13 cedis, what it means is that anybody who comes to buy the good would have paid for the cost of producing the good, which is 10 cedis, and in addition has paid the tax. So in this case, we will say that the producer has comfortably shifted the tax burden to the consumer. And we know that producer can do this when demand is inelastic, because when demand is inelastic, consumers don't complain, or consumers complain all right, but they will still buy anyway when the prices increase. Medical care, you go to the hospital, you are sick, and the doctor said, oh, pay this amount, which is a very high amount. You might complain, but you still pay. So when demand is inelastic, you can comfortably do this. Now, let us explore another option. If the market price now is still 10 cedis after the imposition of tax, it means that the consumer buys it and pays for only the cost of producing it. So who pays the tax? The producer will pay it. And this will be the situation of perfectly elastic demand, because you are afraid that if you increase the price, consumer will even stop buying. I hope you get it. Now let us have another market price to see. If the market price is, this time around, 11 cedis, when consumer buys it, consumer has paid for the cost of producing the good and has paid 1 cedi of the tax, which is a less amount of the tax. So the rest of the tax, which is 2 cedis, producer will pay it. So in this case, the producer is paying greater percentage of the tax, and that's a fairly elastic situation. If the market price is 12 cedis, it means that consumer is now paying 2 cedis of the tax out of the 3, and producer is paying 1. And this will be possible where consumer will pay greater percentage of the tax when demand is fairly inelastic. That is, when price goes up, but they would decrease their quantity in a very small way. Now, we have another market price option. If we sell it at 11 cedi 50 pesos, it means that the consumer pays 1.5 or 1 cedi 50 pesos of the tax, and producer will pay the rest. So, in this case, there is equal share of the tax burden. There is equal share of the tax burden. Now, take note, there are certain things we need to know before we draw diagrams. We need to know what is equilibrium price. We've learned that equilibrium price is the price where demand will meet supply. I hope you get it. So I want to represent the equilibrium price by PE. So wherever we see PE, we say equilibrium price. Now we have PT. The PT here will be the price after the imposition of tax. So in this case, looking at this scenario, if the market price is now 13, then we know that the equilibrium price is 10 and the price after the imposition of tax is the 13. I hope that is clear. If now the price is 11, then the equilibrium price is still 10, but the price after tax will be 11. Good. Then we also have what is called producer's revenue. Producer's revenue. I want to represent by ProRev. Take a particular attention to this because it is going to help us a lot in our graphical representation. Now, if a consumer buys the good, whatever money that comes to the producer without tax is producer's revenue. So, if the cost price is 10 cedis and government is not charging any tax, the money that comes to the producer is producer's revenue. without tax. So producer's revenue before tax is a 10 cedis. Now, let us take it that government has imposed a tax of 3 cedis. And now, let's say, producer is selling at 10. So we know that the PE, which is the equilibrium price, that is price before tax, is 10. Now let us change the price after tax. Let us take it that the price after tax is rather 12. So price before tax, which is the equilibrium price, is 10, and price after tax is 12. Please, I hope you get it. So in this case, we are saying the equilibrium price is 10, price after tax is 12. Now when the producer received this 12 as the price, that price doesn't become producer's revenue because the producer would have to pay tax out of that amount. So after the producer has paid the tax, whatever will be left with the producer becomes producer's revenue after tax. So the tax amount is 3 cedis here. Producer pays the tax, which is 3 cedis, and what is left with the producer now is 9 cedis. I hope you get it. So this 9 becomes producer's revenue after tax. But before the tax, the 10 cedi was producer's revenue. After the tax, producer's revenue is 9 cedi. I hope that is clear. Good. So we've talked about equilibrium price or price before tax, price after tax, producer's revenue. Now, we should note that consumer's tax or the tax consumer is paying will be the difference between the price after the tax minus the price before the tax, which is the equilibrium price. So with this same example, if the price before tax is 10, price after tax is 12, then it means that consumer is paying 2 as the tax, as we said. So it will be the 12, which is price after tax, minus 10, which gives us 2. So consumer's tax becomes 2. Now let's see the producer's tax. We know that the tax amount is what the consumer is paying plus what the producer is paying. So if the tax we know to be 3